$50,000 in potential losses is hiding in your portfolio right now, and most US investors with Canadian stocks don't even see it coming. Here's what most people believe. A Canadian recession will have minimal impact on US investors. After all, the US economy is separate, right? Our stocks trade independently. Canada's problems stay in Canada. That belief is about to get expensive. Research from the Bank of Canada shows something most portfolios miss. A Canadian recession could trigger a 10% decline in the Canadian stock market. For someone with a $500,000 portfolio carrying typical Canadian equity exposure, that 10% drop equals $50,000 in losses. That's not theoretical. That's real money, sitting in your account right now at risk. And the timing matters. Canada's economy is showing the exact warning signs that precede recessions. This isn't a distant threat. It's a 12 to 18-month window. Let me show you why this matters to you specifically, and what the data says you should be doing about it. ***, the wrong belief vs. The reality ***, most high-income professionals diversify internationally for one reason: spread risk across geographies. Canada feels like a natural choice. It's developed, stable, and culturally familiar to U.S. investors. Nearly 40% of U.S. international portfolios include significant Canadian exposure, either through Canadian banks like TD or RBC, Canadian energy stocks, or Canadian-listed tech companies. The belief is simple. Canada's economy cycles independently from the U.S. A Canadian slowdown won't ripple into U.S. portfolios. Here's what the Bank of Canada actually projects. They are signaling potential GDP growth of just 0.9% in 2025. With rising unemployment and persistent consumer weakness. Compare that to historical recession thresholds, negative growth for 2 consecutive quarters, and Canada's trajectory looks uncomfortably close. When recessions hit developed markets, stock multiples compress. A 10% market decline in Canada isn't an outlier, it's the historical median. From 1980 to 2020, Canadian stock market declines during recessions averaged 18-24%. A conservative 10% scenario is actually the optimistic case. The delta. For a $500,000 portfolio with $300,000 in Canadian exposure, a typical diversified allocation, a 10% Canadian market decline costs you $30,000 immediately. If you're holding more, say $400,000 in Canadian stocks, you're looking at $40,000 in losses. At $500,000 in Canadian exposure, that's the full $50,000 the research shows. ***, where the risk concentrates ***, not all Canadian stocks face equal recession risk. The data shows clear sector vulnerability patterns. Canadian banks, Toronto Dominion, Royal Bank, Scotiabank, are the first casualties. Their leverage plays on consumer credit. When unemployment rises and mortgage stress increases, bank earnings compress 25-35% in recession scenarios. Historical data from the 2008-09 recession shows Canadian bank stocks declined 35-50% peak to trough. If you're holding Canadian financial stocks as your safe diversifier, recession will prove that wrong. Canadian energy and material stocks face a different pressure: commodity price collapse. During the 2015-16 energy downturn, Canadian oil stocks fell 45-60%. A recession typically triggers a 15-20% commodity decline as demand weakens. Canadian mining and energy firms have minimal pricing power during recessions. The one exception: Canadian utilities and dividend-focused infrastructure stocks. Historically, utilities outperform in recessions by 10-15% relative to broad markets. If you're repositioning, this is where defensive rotation happens. ***, what the research says you should do. ***, this isn't a call to panic sell. It's a call to rebalance intentionally. First, audit your Canadian exposure. Know the exact dollar amount. If you're at $300K plus in Canadian stocks and you haven't stress-tested that position for a 10-15% decline, you've skipped a critical step. Second, shift from cyclical to defensive within your Canadian holdings. Rotate from banks and energy into utilities, infrastructure, and dividend-paying consumer staples. The math: utilities typically outperform cyclicals by 12-18% during recessions, according to S&P historical analysis. Third, consider geographic diversification beyond Canada. European stocks, Asian developed markets, and emerging markets offer uncorrelated recession patterns. A recession in Canada doesn't automatically mean recessions everywhere else. The deeper framework and sector-by-sector math, it's in the companion resource, Market Cycles Decoded. The link is in the description. The bottom line: you have 12-18 months to reposition. Waiting until a recession officially arrives means taking losses on forced selling. Acting now means protecting the $50,000 at risk. If this changed how you're thinking about your Canadian exposure, subscribe. I'm breaking down the 5 Canadian stocks facing the highest recession risk next week. Hit the bell so you don't miss it. Markets reward the patient and the prepared.